Hello, everybody. Today's episode is going to be about, can I retire? This is one of the most common questions that we get when clients or prospective clients reach out to us and they're booking a meeting. Is want to make sure they're on pace to retire, and can I retire? I've recorded plenty of episodes talking about, like, what is it you want retirement to be like what purpose, lifestyle, like what is it you want to do, the details like that, which are, I think, more important to discuss so you understand what that lifestyle looks like. And then we can look at the cost of that lifestyle. That's an important piece. But today's episode, we're going to go through a quick calculator on a sample client on whether or not they can retire and the different variables that they should consider. So, welcome to Built for Life, Not Just Wealth. My name is Ryan Burklo, and I'm excited to go through this calculator slash really kind of exercise that we take a prospective client through. Make sure you check us out on our YouTube channel, Built for Life, Not Just Wealth, as well as our website, builtforlifenotjustwealth.com, where you can get the video. The visual side of today's episode will be, I think, very helpful for many of you. So without further ado, let's dive into the illustration, or really the financial balance sheet that we're looking at here. So what you're staring at here is someone's personal balance sheet. And, on many levels, it looks really good, right? Let me just share with you what you're looking at, as well as for those of you who are just listening to the audio. We've got someone that's got $300,000 sitting in cash, $750,000 in investment accounts. That's accounts that are not inside of retirement accounts. 3.1 million in retirement accounts. Only 150 of that is in Roth. They have a house worth 1.5 with a mortgage of $500,000, and they've got a car loan at $30,000. This couple makes about $500,000 a year. And so they're looking at, what they can do in terms of, can they turn on a high enough income stream to suffice their lifestyle? And the homework that they did, they think they're going to need about $250,000 of income to live the lifestyle that they're accustomed to. They're age 55, I believe. Yep, 55 years old. And they want to retire in 5 years. So can they retire? So let's look at the retirement readiness factor of their balance sheet, what they look like. So again, here's what we're looking at. Age 55, 5 years until retirement. So their current cost of living is $250,000. So their cost of living at retirement is actually $289,000, almost $290,000 when we put a 3% inflation rate on that $250,000. As we look at those numbers that I mentioned, the savings, the cash, and the retirement accounts, what they look like at retirement here is roughly about $5.3 million of retirement assets. And when we look at the income that they can kick off, they're roughly kicking off 211. Now, this is utilizing like a 4% rule type of distribution. We can get more in the details, but keep in mind, this is a first meeting with a potential client. We're not going to get into the weeds. We're trying to keep this ultra simple for the client. $211,000 of income utilizing that 4% distribution. And if you don't know what that means, is the rule of thumb is you've got your total assets. The rule of thumb is you can take 4% of your total assets every year with inflation, with a lower risk of outliving your money. So 211 is what they've got coming in the door here, but they've also got Social Security also coming in the door. Now, this doesn't include taxes. And so we're utilizing a tax rate of 25%. Now, that's slightly high, but we always kind of prep for simplicity as well as on the high numbers, just to make sure we're not underdoing any of these numbers. And if they've got 50 grand each annually coming in the door of Social Security, now this is at age 60. So they're not going to have $100,000 coming in the door in year one for Social Security, because they'll only be 60 years old. This is going to be full retirement age for them, which might be 68 years old for them. But we are looking at these numbers from a holistic standpoint. So in reality, the $2,000 will not be there in year one. Now, that would cause question of, okay, can we spend more money early on to offset what would be coming in the door? And then when we turn on Social Security, maybe we can take less from our assets. That's definitely a play here. So when we look at this um, aspect here, what they're currently looking like, is their income enough? Not yet. They needed 289. They can only kick off 211. We might be able to kick off the extra, call it $60,000 that they need, and then turn on the Social Security later on. That is a possibility, but it's a moderate, right? This is a scorecard that they're going to get at the end of the meeting. It's a moderate chance, and I think with planning, we can actually make that a higher chance. Then we want to look at protection pieces. So when we look at protection pieces, we're looking at life insurance. So they've got $4 million of life insurance in place. They don't have any long-term care insurance in place, and they don't have their legal documents in place. We put their life insurance at $4 million. We put that at moderate. Then we want to look at assets. And a key aspect of it is we want to make sure that they don't have all of their assets where the market can make or break when they retire, or how much income they could possibly be taking from that. And so we look at it from a true liquidity aspect, meaning how do they have any assets that's not correlated with the market? And they've got some. They've got the 300,000 in cash, but it's not a lot. And so we've got that as a warning, because depending on how they're aggressive in the market, this could be a shock to the system. If the year that they go to retire, if that year they're down 10%, now they're going to question whether or not they can retire. Or sequence of return risk comes into play here as well. And if you don't know what sequence of return risk is, really the first 5 years of retirement, the market rates of return have a huge effect on whether or not you outlive your money. And if you have 3 years or 2 years of negative rates of return, and especially double digits rates of return, and you're taking too much money from your assets, your likelihood of outliving your money go up by quite dramatically, which is why we want to have different buckets of money that offset that variability. So we've got that as a red. Okay. Then we want to look at liabilities. In this case, they're actually looking really good. Their mortgage is $3,000 a month, so I'm not too worried about that. They do have the car loan, and they're paying about $1,000 a month there. Now that's going to make this red, only because obviously we don't want debt. But in reality, I'm not too worried about $1,000 a month car loan for them in this aspect. And so when we look at the summary, right? They get a scorecard at the end of this meeting, and they kind of get a high level overview of what they look like financially when it turns into turning on an income stream. That's the biggest aspect that most people don't quite get. Most people, they're used to a paycheck coming in the door for the last 40 years of their life. And now they're questioning, well, how do they turn on the paycheck when they're turning on the paycheck from their assets? And what are the risks associated? So this scorecard gives them some of those risks. One, as we already discussed, amount of income, they're moderate, and we can do some steps to help them get there. Two, we tend to like some amount of guaranteed income. Now, we don't have Social Security in there, so that would change this a little bit. But right now, their first year of retirement, there is no guaranteed income that's coming in the door. We mentioned the life insurance, long-term care, and estate planning. On the asset side, having assets that are not in the market, as well as how much of their assets is inflation adjusted. And then from a liability standpoint, they're looking really quite good on that. And so I'm going over this scorecard with you today because I think a lot of people want some version of this, and we want to make it available to you. So if you want any kind of access for a financial scorecard for your retirement planning, reach out to us, and we can set this up so you can get a scorecard for yourself. You're saving money so that you can turn on an income stream later on in life. And I don't care if you're 30 years old right now, or if you're 65 years old right now, you're putting money in places that have an effect on whether or not you can retire and have that income stream later on in life, as well as living your life today. Taxes, market variability, protection of your income, estate planning, and liquidity are all pieces that come into a financial plan. And that's the holistic piece that most people know. they're only thinking about rate of return. And if your only variable that you're worried about is rate of return, it's the one variable that you really can't control. And that's the variable that can also have you not retire when you want. Right now, the market's going bonkers. Alex and I are getting slammed with people that were hoping to retire this year, and they're questioning, can I? And I hate to say it this way, if you're questioning that, it's either A, you don't, you're really trying to figure out how to return on an income stream, or B, you've set your plan up so that the rate of return is what's going to make or break you. And Alex and I will never set up our clients for that piece. And so we want to make sure we're setting up our clients so that that's not the case. So with that being said, head over to builtforlife.notjustwealth.com, and at the top of the page is a contact us. Please, if you're looking at getting your own financial scorecard, reach out to us. We can get this set up and go over this with you. If you got any value out of today's episode, share it with your friends, your coworkers, your family members. There's going to be links in the show notes. Click on those show notes links for the visual side of this as well as the scorecard. I hope this episode is valuable for you. As always, make it a great day.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities, LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities, LLC. OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
8849511.1 expiration date March 2028.